Want guaranteed returns and passive income? I'll show you how. Hey guys, if you have seen my starting in stocks videos, these are going to be a little different. I'm going to go into depth on some different financial terms in basic language and give a clear call to action. Let's go ahead and get right into it. The first term to understand is going to be dividends. If you haven't heard of dividends, here's the hook. It's guaranteed return in a way to make passive income. That is to make income without actively working. However, as in all things in life, unfortunately it's not that simple, and there are some caveats to know in order to be effective in investing into dividend stocks. Firstly, we have to know what is a dividend. As you remember, when you buy a stock, you become a partial owner of whatever company that you're buying. A dividend is a recurring payment that the company makes to you and all other shareholders simply for being shareholders. This means that you get cash in your pocket every year based on the company's dividend yield. The yield simply being the percentage of the stock price that they pay out. Dividends usually get paid out annually, quarterly, or even monthly. But either way, it's always going to be the same yield. They just cut it up into different segments. So let's look at an example. Take the company Johnson & Johnson, ticker J&J. This is a great blue chip that's in the S&P. As you can see here, they have an annual dividend of $4.04 with a forward yield of 2.79%. That means in the upcoming year, they're expecting to pay $4.04, which is going to be 2.79% of their stock price. On average, they've had a dividend yield of 2.68%. That means the annual dividend that they've paid has been on average 2.68% of their stock price. They pay a quarterly dividend, meaning that you get all four payments equal up to that 2.68%. This means no matter how the stock is doing, you'll be getting a cash return of 2.86% on average by holding one stock of Johnson & Johnson. However, a trap that a lot of people fall into for dividends is that bigger is better. Some companies can pay out as much as 10% to 15% in dividends. Now, it can be tempting to see that as a guaranteed 10% return. That's completely risk-free. However, that's definitely not the case. To understand this, you need to understand the opportunity cost, that is the alternative cost that companies take on when paying dividends. Dividends are paid with whatever extra income is lying around after all expenses have been paid. However, just because a company has the means to pay dividends doesn't mean they necessarily should. That extra cash can be reinvested back into the company for further growth. So by paying dividends, the company is not using that extra cash to expand opportunities, which in turn could directly increase the stock price. This means that it is up to you to decide if a company's shareholders' best interest is to have a dividend or not. For a large company like Johnson & Johnson, they already have so much extra cash and are so mature that they have very little room for growth. So that means a dividend makes sense for them. And they've been paying an increasing dividend for the last 30 years, so I'll happily take a 2.7% dividend for them because that is the best use of their cash. However, if I were to invest in a small, speculative, growing tech company, then I definitely would not want a dividend payment. This is because the money would be much better spent going back into the company and in turn producing growth, which would in turn increase the stock price. To put some arbitrary numbers behind this, let's look at an example. If I pay $10 to buy one share of a company, and then the company decides not to pay a dividend but instead reinvest the cash, and in a year they're able to grow, increase the stock price to $15. As you can see here, new minus old over old to figure out your return. That's a 50% return. That's very good. Now let's say the same company, I were to buy one share for $10. They were to pay a 5% dividend, but now because they're paying this dividend, they have less money to put back into growth and reinvestment in the company. So let's say the stock only goes up to $13. We see new minus old over old is your return of 30%, capital gain, plus a 5% dividend equals a 35% return. So obviously less than the 50%. Now these numbers are completely arbitrary, but it just shows you the idea that I'm trying to convey. As an investor, the question you need to ask is, would I rather have the money in my pocket to reinvest on my terms, or will the company be able to reinvest that money more effectively by keeping it in their pocket? And that's a very hard question, and it varies by company to company. So personally, it's not one that I try to answer. The easy way to avoid this question is just by buying blue chip stocks that have a history of at least 10 years of increasing dividends. That means their dividend is getting larger as their stock price gets larger. As you can see here, J&J has had a steadily increasing dividend since the 90s all the way to 2020. It's been going up with their stock price, and this is a very stable long-term investment to make. That's all for today. Make sure to subscribe and like the video, and I'll see you guys next time.